Welcome to everybody. Today, I will introduce the methodologies to evaluate entrepreneurial projects, and especially startup businesses. Evaluating an enterprise is very important for a number of reasons. First of all, it is a metric to understand the best investments that entrepreneurs should consider in order to maximize the value of their company. Then, evaluation is important for existing and potential investors, because in exchange for their money, they expect a profitability. Equity investors want to see the value of the company to increase in the future. Debt investors want to be sure that the value of the company is large enough to avoid bankruptcy and default. Yet, evaluation is a complex task. The more complex, the younger is the company and the larger the business risk. As the picture shows, there are several alternative methodologies to evaluate a business, depending on the type of the business we consider. And we will analyze only the most important. Asset-based valuation techniques are commonly adopted for real estate projects and holding companies. In such cases, the value of the company is mostly depending on tangible or financial assets that are easy to be evaluated. Relative evaluation relies on the assumption that we can estimate the value of a business looking at the multiples of a set of comparable companies listed on stock exchanges or to comparable transactions on the M&A market. Let's make an example. Assume we want to evaluate company X. We know that the current EBITDA, earnings before interest, taxes, depreciation, amortization, is equal to 1 million euro. We found 3 similar companies, meaning in the same industry, similar size and age, listed on stock exchanges. Considering their current EBITDA and their current market capitalization, which is the market price of their shares times the number of shares outstanding, we find that on average the comparable companies are traded at 4.9 times the EBITDA. That is, a first measure of company X value could be 4.9 times 1 million euro, which is 4.9 million euro. A similar estimation can be made looking at the multiples of the acquisition value for comparable companies, if available. Finally, DCF methodologies, where DCF means discounted cash flows, assume that the value of the company is driven by its capability to generate cash flows in the future. This technique is recommended if we are considering a company that today is not profitable and has no particular tangible assets, but is expected to deliver profits and be able to generate revenues and profits in the future. This is the typical case of startup companies, but in general of many technology and ICT companies. When applying DCF methodologies, we are not allowed to say that the value of the company is just the sum of the future cash flows that the company will display, because time has a value. In fact, it's better to be paid immediately 100 euro today than the next year, because on the market there is the opportunity to invest our money today in different alternative assets: stock, bonds, gold, real estate, properties, for example, and obtain more than 100 euro at time 1. In other words, there is an opportunity cost of capital to be considered. As a consequence, we have to compute the so-called present value of a future cash flow, which is the equivalent value today of a future cash flow. Look at the picture. We have a cash flow at time 4. Let's call it FV. In order to compute the present value today, we divide FB by plus 1k to the power of 4. The opportunity cost of capital depends on the risk of the cash flow. The larger is the uncertainty related to the amount of the future cash flow, the larger is the risk, the larger is the required cost of capital, because people want a larger reward if there is a larger risk. In the case of a startup company, the cost of capital used by investors and entrepreneurs to discount the future cash flows can be as large as 20%, 25%, or 30%, because of the significant risk and early stage of the business. An application of the DCF methodologies is the venture capital method, and we will look at one example right now. Assume we have to evaluate a startup company. From the expectations contained in the business plan, we know that at time 5, the company could be able to deliver an EBITDA equal to 1.5 million euro. Obviously, we cannot be sure of this, and there is a significant risk. We decide to apply a multiple, as defined in the previous example, and obtained from comparable companies and transactions, for example, equal to 5. Therefore, we evaluate the startup at time 5, 7.5 million euro. In order to obtain the value at time 0, we discount with an appropriate cost of capital, say 25%. The value today of the startup is about 2.5 million euro, as you see from the picture. Now assume that the company needs 1 million euro cash to survive. The question is, what is the percentage of the equity capital to be sold to an outside investor in exchange for the money? A simple proportion tells us that we should propose 40.7% of the equity capital. The value of 2.458 million euro is called the post-money valuation of the business, because it's the value of the company conditional to collecting the cash in the equity round. The difference between the post-money valuation and the amount raised is the pre-money valuation. Surely, we may agree that the evaluation depends on some relevant assumptions, and the change in the assumptions will lead to a different value. So, it is recommended to perform a sensitivity analysis in order to check the robustness of the results.